Welcome back to F.A.C.E, Eric.
Hey guys, thanks for having me back.
All right, so you got a big
Hey, Eric.
build-up. You got a big build-up from Blake, so I hope you don't feel too much pressure that you have to be really,
I know you're putting me on the spot
elite.
here.
Can you handle it, buddy?
So yeah, I think what I'll do is I'll run through a couple of slides here.
All right.
And then maybe you can just stop me along the way if you have a question or something's confusing. Because if you have a question, everyone probably has a question, and it'll help maybe get my
Okay.
point across.
Well, let
here.
me lead it off with a question before you go to the slides.
Sure.
Something we're talking about. And I get your emails and I'm reading your stuff and I agree. And I think that what happened with SVB is going to create a credit crunch as well. How is it possible for the market to go down when everyone's bearish because of the fundamentals? And do you think that eventually these fundamentals are going to catch up with the market that seems to be levitating?
Yeah, so I think that as I go through some of these slides, we'll sort of contextualize the pocket of the market that we're in right now in terms of the economic cycle and why it's not really unusual that the market's going up, and we'll quickly realize why this is the most dangerous period. So as you know, Dale, and the people who have been following my work and from my last several appearances on the show, I've been quite bearish about the direction of the economy and suggesting that the economy would go into recession sometime at the end of last year or the beginning of this year. It's been my forecast for quite some time. But now we keep hearing people say, well, it keeps getting delayed and it keeps getting delayed. So what I wanted to do here was try and refine the timing a little bit more and clarify the fog of these cycles, because we, as a collective market, never realize the economy's in recession until many months after. And the NBER doesn't tell us until over a year after. So we have to do a better job of trying to assess when exactly the economy descends into recession, because it's quite often that the economy goes into recession and the market doesn't realize it for many months. The best example, the most recent example, would be the 2008, which is that the economy went into recession in December of 2007. And then the market rallied all the way to within 8% of its all-time high in May of 2008, after several banking events not dissimilar to what we've had today. So the market does have a tendency to shrug off some negative news when the recession is already underway. So my process involves, as you know, Dale, tracking leading economic indicators and coincident economic indicators. As the name suggests, leading economic indicators turn down ahead of recessions. So this, for the chart that I'm showing here, is the Conference Board leading economic index. Most people are familiar with this, and you can see that the growth rate of the Conference Board leading index reliably turns negative ahead of recessionary periods. There are a couple false signals. They're not that common, but what I'm about to show you is a way that we create sequential signals. So you could see here that the growth rate currently is negative 6.6. Never really seen outside of the economy already being in recession, which is one of the reasons why we can emphatically say that the economy is likely in recession now. Okay. The coincident index doesn't tell you where you're going, but this is how you define recessions. Coincident indicators, as defined by the National Bureau of Economic Research, include employment, income, industrial production, and consumption. So you have your four major buckets, employment being the largest one, which most people track. And what you'll notice, the difference between the leading index and the coincident index, is that the coincident index doesn't turn negative on a 6-month growth rate, which is what I'm graphing here, until the recession is already underway. If you go to the recession start periods, you'll notice that the recession actually begins when the coincident index is in the 1% range and the leading index is in the negative range. Does that make sense?
Yeah, got it.
Okay. So what we're going to try and do is we're going to try and establish some of these lead lags and just some basic triggers. So Jeffrey Moore and Victor Zarnowitz were two of the pioneers of this leading indicator type research. And what they did was they tried to create a signaling process. So the first signal, Dale, which is when you have to put your alarm bells up for the very first time, is when the leading index falls below 2%. And the coincident index can be wherever you want. But whenever the leading index falls below 2%, you have to be alert to the fact that trouble may be brewing because the leading index has fallen below trend, right? If the leading index falls to 1%, you don't know if it's going to be a recession, but you have advanced warning that a period of below trend growth may be coming. Does that make sense?
Sure.
So here I've denoted all of the times that you get this.
Who taught you that sales technique? I'm just curious. Where in your background did you have someone train you to use to say something and then end it with, does that make sense? Come on, be honest with me.
No, I'm genuinely trying to make sure that we're following along, because this can get confusing, but it's extremely important, and it's going to get even more important if you let me go to the next signal here.
Okay, does that make sense?
Does that, you got to say yes every time.
Told me? Okay. Yeah. All right. Go ahead.
Okay. So
busted.
You get a first signal when the leading index falls below trend. Now you get a second signal when the leading index falls below 0% and the coincident index falls below 2%. Why is that the second signal? Because if the leading index falls below 0, that's suggesting that the coincident index may fall below 0 in the future. And if the coincident index is sitting below 2%, then you have a period where the leading index is negative and the coincident index is below trend. I'm going to say it again. Does that part make sense?
Yes.
Okay. So I've noted every time you get a second signal, which is leading index below 0 and coincident index below trend. So where are we today? The leading index is far below 0 and the coincident index is below 2%. So we have a deeply negative leading index and a coincident index that's below trend or vulnerable. So you have a second signal. You'll notice, Dale, that never in history do you get a second signal without there being a recession. The reason is because if the leading index is negative and the coincident index is below trend, it's almost impossible for the coincident index not to fall below 0, which is ultimately a recession. So the third signal, Dale,
so
which
the blue vertical line with a little, that is the confirming signal. That's a second signal.
That's a second signal.
Okay.
And so now we're going to go for our third signal, which is 100% confidence that a recession is underway. And the way that we define that is when the leading index is still below 0, meaning that the economy can't recover, and the coincident index is below 0. Obviously a recession, right? Mm-hmm. As you could see, it very closely defines the actual NBER recessions, but we're doing this in real time rather than with 2 years of hindsight. So you can see how you get progressive signals on growth is going to slow down, growth is likely to go into a recession, growth is in recession. Does that pencil out?
Yeah. I wanted to ask you, Eric, that, since you're getting the edge on conventional economists, how do your clients use this information, on business, whoever, you might have institutions. Do they use this for, preparing by maybe layoffs or cutting costs prior? What's the advantage of knowing early about something that's going to happen?
So,
Go ahead.
putting some numbers on this, which will help answer that question. On average, you get a signal 1. So you get your
Yeah.
first signal on average 13 months before the recession starts.
Wow.
So whenever you get a signal 1, you can alert your clients. Let's say I'll use one client as an example. That's a manufacturing company.
Okay.
I can alert them to the fact that there might be a recession a year in the future. We don't exactly know because, as the chart shows, sometimes you get a signal 1 without a signal 2, but you never get a signal 2 without getting an actual recession, right?
Okay.
So you can alert them to the fact that, hey, things look like they're going to soften. It's time to prepare. And 13 months is certainly sufficient for even a big ship to move, like a manufacturing company.
Yeah.
You get the signal 2, which is your signal to your either money manager or to your board or to the manufacturing company is, we are 100% going to have a recession, and the average lead time from a signal 2 to a recession is 6 months.
Yeah. You
So
better
when you
get
get a
going.
signal 2, you have 6 months. Now, Dale, this is the part that's extremely critical. You get your signal 3, which is your real-time, guaranteed, nobody can dispute it. Everybody's hair is on fire, because basically what that signal 3 is that labor is negative, right? Job growth is negative.
Yeah.
There is a 2-month lag. So the best we can do in real time is a 2-month lag. So 2 months after it actually begins, but most people don't realize it for longer than that. And then the NBER doesn't tell us for over a year. So if we can define a recession with a 2-month lag on average, that's pretty good.
Yeah.
So
It
what
is.
that means is there's an 8-month pocket between when you get a signal 2 and when you get a signal 3 on average. And what that pocket really is a guaranteed recession, but nobody believes it yet, which is the pocket that we're in now, because we've had the signal 1 triggered 12 months ago when the average is 13, and the signal 2 was triggered 5 months ago when the average is 6. So we're,
Yeah.
it's potential,
So,
it's already started. It's potential,
Mhm.
it's 1 or 2 months away. These things are impossibly difficult in real time. And also we'll have revisions that may skew this, but we're in a pocket now where a recession is virtually guaranteed, and it could be underway already, likely is, but the market doesn't realize it yet. And these are the pockets that you refer to in pre-recessionary periods, like the period from for example, you got a signal 2, Dale, in July of 2007. But most people
Yes.
didn't realize the economy was in recession until really the second quarter of 2008. And there were large rallies that happened, like we're seeing
Yeah.
today. But that is the way that this information would be used. Now, it's difficult for me to articulate a trading strategy around this, because everyone is completely different and has different priorities and strategies and risk management systems and
Plus,
all the
it's
rest of it.
difficult.
And
Period.
plus it's difficult. It is difficult.
So
So
can I ask you if there's anything in your data, the big debate, the narrative, and even no landing got into the narrative for a little while, still out there. Is there anything in your data that tells you the severity of the guaranteed recession?
so one of the things that we can do is just look to the magnitude of the decline in the leading index so far, which has been pretty sharp. We don't exactly know the magnitude yet, because it really depends on what crises hit as a result of the recession. It's I feel like it shouldn't have to be said, but I think it does. A recession causes the unemployment rate to go up. the unemployment rate going up doesn't cause the recession. So the recession begins, and then the unemployment rate goes up. And whatever landmines are exposed as a result of the unemployment rate going up and people and businesses defaulting is a large contributor to the severity of the recession. That is very difficult to know with a business cycle type framework, because I'm not getting into the nitty gritty of what toxic assets specific banks are holding, as an example.
Well, how about a credit crunch? You've seen most recessions come with credit being more restrictive, and
Right.
that doesn't really
Right.
fuel growth.
Right.
So
I'm ducking and dodging your question a little bit, because magnitude's the hardest thing to
okay,
guess. But I'll improve my answer a little bit. There's a couple of things we know about the magnitude. One is, how fast does the Fed start cutting rates after the recession begins? Right? The lag of the Fed. And this is particularly problematic because the Fed needs to be cutting rates aggressively when you get a signal to, because when you get a signal to, you're going into recession, and there's nothing that anybody could do about it. We got a signal in July of 2007, as I mentioned. The Fed had paused interest rate hikes in the summer of 2006. So the Fed was on pause for a year. And then we got a signal to, and then the Fed started cutting rates. Actually, about that time in the summer of 2007 is when the Fed started cutting rates, and the economy still went into a deep recession. What's extremely troubling today is that we have a signal to a recession is either imminent or already started.
and we haven't even paused.
And the Fed is still tightening. And Dale, all of this data that I'm showing is as of February. So this does not yet reflect anything with the Silicon Valley Bank or regional bank crisis more broadly, which you could argue is neutral at best and negative at worst. So we have a Fed that's still tightening and a private credit crunch that still hasn't been reflected in this data. And what's concerning is that a lot of people are saying, we have to wait to see how this plays out, to see if the economy is going into recession, when the economy was probably already in a recession before that event even took place.
Got you. All right.
And then, I just want to round out a couple more slides that I showed in my last weekly email, which you said that you were on. I'm not sure if this was in it or this was behind the paywall, but everyone is saying that the labor market is still too strong, which is why we get this 8-month lag between the signal 2 and the signal 3. But job losses always begin in the cyclical sectors of the economy. The total non-farm payrolls, the headline number that everyone reacts to every first Friday of every month, that doesn't usually turn negative until on average 2 or 3 months after the recession already began. The cyclical jobs, which is what's really tethered to these leading indexes, because the leading indexes are very sensitive to manufacturing and construction and trucking and things like that. The cyclical jobs lose, or the cyclical part of the economy loses jobs first. So when we look at the what I would define here as the cyclical sensitive jobs basket, which would be manufacturing, construction, trucking, and temporary help, 26 million payrolls, not an insignificant amount. We've lost 65,000 jobs cumulatively over the last 5 months. So there are job losses happening in the manufacturing sector, the construction sector, the trucking sector, and the temporary help sector.
It's interesting you say that, because pull-up cat, pull-up deer, a lot of these stocks that have to do with exactly what you're talking about, tractors for building things we live in and work in, those issues have been under severe pressure.
That's exactly right. So that is why I would have increased confidence that okay, we're clearly in this period where we're in this lag between a signal 2 and a signal 3. It's extremely dangerous because the chances of not getting a signal 3 or a recession, at least based on history, is 0. And we have no upturn yet in our leading indicators, and our cyclical sectors are hemorrhaging jobs currently. So all of that put together is an extremely high probability setup here, and the fact that the market's not realizing that is quite dangerous. So, I'm not a trend follower. Obviously, I take a longer term view here, but I thought this may help clarify and also set the record straight as to why some people may say, well, you've been negative for quite some time. Well, over a year ago is when we got our first signal, which is when I began to alert clients and, public appearances of a pending recession. And the timetable that I gave was roughly Q4 of last year, the beginning of this year. Difficult to do in hindsight, but based on the way that the data is playing out, it's unlikely, in my view, that the economy is not in recession currently or will be in the next month or two. And it's really just a matter of time until the market figures it out, unless the last 60 years of history and data are not true.
What a profession. They hope you're not right, and then when you're early, they're upset that you're early.
It's a tough job, Dale. It's a tough job.
Can't please all the people all the time.
No, but what I can promise to my clients, which is different than a lot of people who are more focused on market movements and asset prices, and understandably so. But I am not swayed at all by rallies in the market or a lack of a crash or whatever it is. I'm exclusively looking at the data. So while I got a signal a year ago, which maybe for someone trading the S&P is wow, you were so early on that. But if you're a manufacturing company managing inventory on multi-month cycles, 12 months is not that long of a lead time to sort of get your ship in order.
Eric, so, it protected people plenty during that decline we had in the market in 2022. So, just because we haven't had a crash doesn't mean that there's not a lot of stocks people were in that hopefully they got out of that have lost 70-80% of their value during that time post-bubble. So, I wouldn't even listen to them
and
because we haven't had a market crash. Go ahead.
And you could see in the chart here that all of the white space, which is a majority of the time, is when you don't have any signals and you're free to take as much risk as you like. But even during the times when you get just a signal 1, the 1996 period, there was softness in the market. 1998, they obviously occur for a reason. In 2016, we had oil go to $20 a barrel. So when you get a signal 1, it's possible that there's a false signal, but usually it comes with some sort of weakness in the market. It's just a time to be alert. But when you do get this signal 2, which is a really deep contraction in the leading indicators and the coincident indicators that are moving towards 0. So the other thing is this data, as I mentioned, is only updated as of February because what's included in this coincident index would be the consumption numbers for March, which we haven't gotten yet. We'll get retail sales on I believe it's Friday, which will give us some indication. And industrial production. We'll get that updated on Friday as well. And again, those numbers are, quasi pre-post SVB. So we still kind of don't have that impact yet. Yeah. And we're already seeing this type of setup here. So
guess on longevity once it's recognized, couple years, 18 months, average.
Average is 12 months once it's realized. So, as a default, I would move somewhere towards 12 months. But what I would say is that, eventually, Dale, I'll come on your program and I'll give you my sequential triggers of recovery, because we can do this process exactly in reverse, which would be something to the effect of leading index above zero while coincident index is still below zero. And you can map these steps just going in the other direction. But the first step before we could even begin to talk about a potential recovery would be that you need the leading index to move above zero. And we're not even close to that. So I don't think when a recovery would not be in the would he be on the table at the moment? So
right, not on the table, but economists and traders still have to live in the future.
And other things that traders could think about as a way to use this information is I would say that the information on these signals is the least timely for the equity market, because the equity market tends to react kind of late, I think, into across all asset markets.
It's like that last snowflake is a tipping point before the avalanche, and
I personally
could build forever.
Yeah, I think the interest rate market is a little bit more timely. But just to give kind of ideas of where I think the market is, even the rates market, which could be more leading, and some of this stuff is that in the average recession, the Fed cuts rates, the year over year change in the Fed funds rate is somewhere between negative 300 and negative 400 basis points year over year. That's like the peak of the rate of change of cuts. So let's call it 350 basis points on average. So hypothetically, if the Fed were to start cutting rates in September of 23, and they got to a peak rate of 5, that would be, and this is again just total averages. That would mean that in September of 24, the year over year Fed funds rate could be minus 350. It could be 1.5, right?
Yeah.
And the interest rate market is pricing it currently at about 3.5. So there's 200 basis points potentially between where the Fed funds could be in September 24 and where the market is pricing it in September 24.
Hey, Eric, I'm Dale. I'm sorry, I hate to interrupt, and I'm not sure if you answered this question or if you guys talked about this, but I wanted to get your personal opinion here. Do you believe that the Fed is or would cut rates with inflation well above 2%? Are you in the camp that the Fed would rather boost growth or support growth and try to avoid a hard landing by cutting rates despite inflation still being elevated? What's your personal thoughts there?
Yeah, that's the trick question there.
Right.
I think that they are worried about inflation, which is why they're late this time to a situation where I think they already would have been cutting. So I think they are already late, but by the time they get around to cutting, which will be, I think, maybe late summer, inflation is not going to be
solved,
the topic of conversation. There's one historical truism of economic cycles is that inflation doesn't go up during recessions. It can go up after the recession. Like that's what we saw in the 70s, where we had recessions which knocked down inflation, but then it sort of resurged after the recession was over to new highs. So the direction of inflation is already heading down. We had inflation on like a 6-month basis peak at 10.5% in June of 22. We're at about 4.5% now. And we haven't had the recession yet. So when the recession begins, which everyone will realize when the economy does lose jobs, inflation will be, I think, 2% and below pretty quickly.
Okay. All right. Thanks. And sorry, I didn't mean to interrupt, Dale.
So yeah, I think by the time they're pressured to cut, they'll have more than enough cover to do so.
Got it.
Cutting rate stabilized the real estate market, which I don't even know how much, what state it's in. I'm in California. It doesn't look like we're having a crash here.
Yeah, it depends what market you're talking about. Commercial real estate looks a little bit more problematic than single family. But single family does look to be a under pressure in certain parts of the country. There's a tremendous build out of multifamily, and all of this commercial and multifamily was financed mostly through these small and regional community banks, not the top 25 banks. So,
There'll be less supply.
If you look at the chart here, if you exclude the COVID recession, which I think you have to do because it really wasn't there were elements of it that were not, traditional business cycle recession.
Yeah.
We haven't had a traditional business cycle recession since 07, 08, and then before that 2001. And what occurred in every recession basically was the Fed cutting rates, but not really helping immediately, because when banks decide to contract credit, they do it really irrespective of the Fed cutting rates, because, everyone says, well, as soon as mortgage rates drop to 5%, the housing market's going to take off, as an example of a narrative that we hear, right? Well, what if mortgage rates go to 5% because the Fed cuts rates as a result of everyone losing their job? Then all of a sudden the rate is going down, but there's less people qualifying to be able to use that rate, right? So you have a situation in a recession where credit contracts irrespective of rate cuts. So I think that's going to be the situation that develops. Is I think the Fed's going to cut.
Who cares what the rate is if you can't get the credit?
Exactly. That's exactly what it is. So I think that when the Fed cuts rates, it's going to be a more traditional business cycle recession. I mean, this is really developing like a traditional business cycle recession because the monetary tightening was so extreme. So the slowdown is proliferating through all of the sectors that you would expect as a result of monetary tightening, namely construction and manufacturing. That's where we're losing jobs. That's where we're getting the signals. So this to me is very much a business cycle recession. Personally, I'm not dissuaded by the market performance. I just believe that we're in this gap between signal 2 and signal 3, which is on average an 8-month gap, which is, as a business cycle economist, I'm looking at this chart, and the gaps between the blue line and the red line don't seem that big. Right? You say, oh, it would be easy. I'm just going to short the hell out of everything at the blue signal. But 8 months then in trading terms can feel like an eternity, because everybody wants to be right every 6 weeks, right?
Every day.
Really, exactly. Yeah. I mean, 6 weeks would be a long time for most people. So what I would say is that, from a business cycle standpoint, 8 months is not a long time.
No.
We got the signal on a signal 2 was December of 2022. So we are, if you use April, because this will continue to get signals for the next 2 months, it's almost impossible that the data is going to accelerate to that extent. So we'll basically be 5 months into a signal 2, which is 6-month average to recession start. So we're just about there.
Follow Eric at EPB Research.
Eric.
And
hey, Dale.
Hi.
I just didn't want to interrupt before. Hi, Eric. Steve's here.
Hi.
A couple of questions for you. You touched on a couple of subjects. First of all, I have no disagreement on your analysis. I think we're on the same page. But the question for me is the following. How low do you think inflation can go due to a recession? Because somehow I doubt that it's going to slip back below 2%. You said that inflation always drops during a recession. And yes, that is the case. But we still have a long way to drop to get sub 2%. So do you think we're going to practically be seeing a stagflationary period?
Historically, inflation drops about 500 basis points in the average recession. So we're about 4% now. So it's conceivable to me that if the Fed allows a business cycle recession, which certainly looks like they are, despite everyone, including my sort of fear of a panicky premature stimulation, it's conceivable to me that we would slip into deflation if the economy went into recession and we didn't see any
Rescue.
repeat of a if they didn't start sending checks to everybody. I would say that, to put it black and white, and this is a little bit of a reductionist statement, so take it with a grain of salt, but the Fed can do basically nothing to stimulate inflation. The inflation that we saw came from the fiscal side. So the Fed can slam rates to zero and inflation's not really going to accelerate if we have a recession. It's basically, to me, it's very conceivable that if we have a business cycle recession, unless we see, aggressive fiscal handouts again, we'll probably slip into deflation.
Okay.
That's right.
Okay, let's see about that. I'm a little bit worried that in this case, this might not be the case. I'm afraid the chances of a stagflationary period are higher than they've been in the past, to say the
Well,
least.
it's all predicated on labor, right? So we've seen a pretty significant drop in inflation so far. Hasn't come all the way back down to where it needs to, no doubt about that. But we haven't hit the part of the cycle where inflation really starts to crater. Now, I would also remind everybody, if I was to do a signal 4 would be inflation, right? Because growth leads inflation. Inflation is a lagging economic indicator. I wish I had the chart to articulate this point, but Dale, how many years on average, or months or quarters, do you think inflation takes to bottom after the recession is over?
Couple years.
It's about 2 years, right? So, one, again, proximate example would be that we had the recession in 2009 and inflation bottomed in 2011 and 12, right? And the reason for that is because of the labor component that lags and then all of the filter through effects that happen through rent and all the things like that. So if we have a recession here in the first quarter of 23 and it lasts a year, this is, again, a super straw man type timeline. So please don't take this with a grain of salt. But if we have a recession that lasts a year, that would take us to 2024, first quarter of 2024, which means that the bulk of the decline in inflation is going to happen in 2024 and 2025.
Okay.
And that's when you'll see the trough in inflation. And again, the Fed was cutting rates starting in 2007, but inflation troughed in 2012. So it's not the rate cuts.
Yeah, and the example that really is frightening is that the Fed was on pause. When was it? 2007.
That's
for
right.
a year.
They paused in the summer of 2006.
Okay, for a year, and even though they paused for a year, we had a pretty good hit to the economy, and we're not even at the pause. Which
is to me most. It's impossible to pin this down to any one cycle that looks familiar, because it's
there aren't any.
There's components to every cycle that are similar. I mean, it's really like an amalgamation of like all these different cycles, but one analog that keeps appearing over and over is the 1974 recession to me. Because that was the last really inflationary recession where real growth fell much more precipitously than nominal growth, which gave corporations what's called the money illusion, right? Where revenues are growing 10%, but unit volume is falling 2%, right?
Yeah.
So you're selling 2% less in terms of the number of goods, but the revenue is 10% higher. So you say, oh, I could still pay the employees because I pay the employees out of revenue. But really what's happening is the productivity is collapsing because those employees aren't producing more units.
Yeah.
And then once the inflation craters in the recession is when you have this sort of flush of labor. Dale, in The recession of 1974, the start date was December of 1973. Okay.
Okay.
When was the first month of job losses?
I can't remember. I was 11.
It was August of 1974. So it was
Okay.
8 months after the recession started. So there was a
Yeah.
huge lag to labor. A lot of different reasons why. One of the reasons that to me is curious is the inflationary aspect to it, where nominal growth has lingered longer than real growth because of this. If you go back to our coincident index here, real growth has been below 2%, back to where it has been historically for many, many months at this point. It's the nominal growth that's sort of hanging in because of the inflation component, which I think is causing a lag to labor in a similar fashion to 1974. One more factoid, Dale, and then you can kick me off the air, is in the 1974, just to give you an idea of how fast the change in labor was, I think it was in July of 1974, payrolls were positive 20,000, plus 20,000 in July. In September, it was minus 700.
Wow.
So in 2 months, it went from plus 20 to minus 700. And those are on, a different population base. So it's, give me some leeway here, but it's virtually the equivalent in today's numbers of something like plus 50 to negative 1 million in 2 months.
Okay, let's wrap it on that potential important event that people will be reading about, and you told us about here, Eric, and appreciate once again you coming here to clarify the dark science of economics and edify the F.A.C.E community. We appreciate what you do for our community, and keep up the great work, and follow Eric. Follow him on Twitter, check out his newsletter. Eric is taking off like we hope the economy does once again someday. So,
thank you, Dad. I appreciate you always having me on. You guys can just go to epbresearch.com, and then there's a free newsletter. You can just type in your email, and you get about one or two notes a week I'm putting out, which kind of gives some color and through the lens of the business cycle. Yeah.
So again, thank you so much, Eric, and rooting for your forecasts and all your clients that were prepared for the flood before it came.
Thanks, guys. Appreciate it. Talk soon.
All right. That's it, everyone. You could
Bye-bye.
join the team on the Morning Edge in 10 seconds. Don't just count your pips, count your blessings. See you later.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.